It was a banner year for international investing as Americans poured an estimated $149 billion into international and global funds. That's a record. But with so many foreign markets posting double-digit returns, is the era of overseas outperformance coming to a close? Here to discuss that, Gary Shilling, president of A. Gary Shilling & Company, who's bearish on foreign funds, and in Stamford, Peter Schiff, president of Euro-Pacific Capital, who, by virtue of the name, literally thinks the overseas markets still have room to run. Welcome, gentlemen, both of you, and Happy New Year to both as well.
Same to you.
Peter, let me start with you. Obviously, you have been involved in the foreign markets for some time, and I understand you've been investing exclusively overseas for the last few years. Do you remain as bullish as you have in the past?
I certainly do. We've been investing pretty much exclusively offshore for about the last 6 years, and during every one of those years, doing that has outperformed the U.S. market rather substantially. The difference is this most recent year, 2005, has been quite different. For 2000 to 2004, most of the outperformance had to do with higher dividend yields and appreciating foreign currencies. But this last year, even though the dollar was relatively strong against many of the markets, the foreign stock markets did tremendously well, just appreciation this year, and that was different. I don't expect that type of appreciation to continue going forward, but I do expect the outperformance of foreign stocks versus the U.S. stock market to continue, particularly since I believe the U.S. dollar is going to resume its decline next year, and I think that's really going to have the wind at your back when you're investing abroad.
Now, Gary, you disagree with that. Why?
Well, I think Peter and I both agree that U.S. housing is going to break and break big, give a U.S. recession. I've talked about that in recent CNBC appearances. The question is, what are the international ramifications? And the facts are that U.S. consumers are very, very important to the rest of the world. They basically buy the world's excess goods and services. We have a huge trade deficit. The rest of the world, most countries have huge surpluses. If you look at it, a 1% decline in U.S. GDP will reduce our imports by 2.9%. That's our analysis shows that. And the losers are the rest of the world. So it's a classic case. We get a cold, they get pneumonia.
See, I think you identified the problem, but you've got the wrong winners and the losers. See, the losers are going to be the Americans when they're off the foreign gravy train. And I think when the U.S. real estate market will collapse, and I think we're going to go into a severe recession, but during that time period, the U.S. dollar will drop dramatically. And when that happens, particularly if it drops big against the Asian currencies, the rest of the world's consumers are going to suddenly have a lot more purchasing power, and as Americans stop consuming, the rest of the world is going to start consuming.
Hey,
what do you think, Gary?
Wait a minute, Peter. The rest of the world, the Asians particularly, are export-driven. They don't consume, they produce, and they export. And the dollar will probably be strong. It has been strong this year. That's been our forecast. We think it'll be strong next year. It'll be the best of the bad lot. Hey, when the U.S. consumer backs off, these countries don't have any place else to sell their excess goods and services.
Look, we're not doing the world a favor by consuming. They do America a favor by producing.
Oh, I don't agree with you entirely. The buyer always wears the guns, not the seller in an excess supply world.
No, there's unlimited demand. We're not producing. The productivity is coming in Asia. They've got the factories. They can produce the goods. They can consume them themselves very fine. They don't need to give them to us for free.
I disagree with you. I don't see how they can consume them. Look at China. Yeah, they got a lot of cell phones and laptops. But the reason is because they have export revenues and direct foreign investment
That's because their currencies are still artificially low.
They don't have a big enough middle class yet to be domestically driven.
Let me ask
their middle class will come overnight when their currencies rise.
Well, let me pursue that middle class argument, because in the last year or two, I've been to a number of these different countries, and I'd like to bring Russia and India into the discussion as well, where there is a growing middle class, Gary, and although it may not be the equivalent of our U.S. middle class, although in India I think you could argue it is on a sheer population basis, does that population not have a buying power now that it didn't have previously?
Probably the greatest gain from the Industrial Revolution was the spawning of vast middle classes. People with lots of money, they want to spend it on the better life, their kids' education, and so on. These countries simply aren't far enough along to have those middle classes. Now, you can't really prove this one way or the other. The statistics aren't there. That's our judgment. But the next recession will tell.
If
we're right, China will be right back where it was. That middle class argument will basically disappear. If we're wrong, hey, it'll be as Peter suggests.
See, it's the Americans that can't afford to consume. We're borrowing to consume. We're borrowing money from abroad to pay for imported products.
And they're very happy to lend it to us.
No, they're not.
Because if they don't lend it to us, the system collapses and they have no place else to sell their goods and services.
They're not happy. It's central banks. It's foreign governments that are doing it. And they're
Maybe
doing it
so,
for
but they're acting in their own best interest in those countries.
Look, they're going to stop, just like Kerkorian.
Oh, really? That's what people said a year ago. The current account deficit was going to sink things, and it was dead wrong. Theory follows fact. That was a theory to explain a weak dollar, and then the dollar turned around like a scalded dog.
You don't throw good money after bad forever, just like Kerkorian came to sense with GM.
Forever's a long time, Peter.
I think next year or maybe 2007 it's going to happen.
Were you saying the dollar was going to be weak a year ago?
I've been saying it for 5 or 6 years.
Well, you were wrong a year ago. Why do you think you're going to be right now?
Well, I've been right for 6 years, and we made so much more money investing abroad.
You've been right on the dollar? You said the dollar was going to weaken a year ago.
Well,
it took off like a scalded dog.
Well, I predicted oil would hit $65 to $70 a barrel, and I predicted gold would go...
We're talking about the dollar, not oil.
And I predicted gold would go over $500 an ounce. Those things both happened.
We're talking about the dollar here.
The dollar has been weak against some currencies. It was strong against the euro and the yen, but that's not going to continue.
How about sterling?
Well, let's leave the currency
look at
discussion.
Australia, look at New Zealand, look at Canada.
Let's leave the currency discussion to a currency play, and I know it's all interrelated to the international markets, obviously, but if we're looking for the best play for 06 for our viewers who are debating whether it's too late to go overseas or whether they should stay domestically, Gary, why should they stay invested domestically, and where should they invest domestically?
Well, I think it's going to be a global recession, and equities are going to be in trouble globally. And as I said in my last Forbes column, I think the international area will be particularly hurt, and the emerging markets more so than others.
But where would you put your money in?
I go to what's been my 25-year favorite, and it's outperformed stocks over that times, and that's long treasuries, treasury bonds. Yields will fall. They're already falling now because investors are starting to get nervous about the economy. And I think with recession and the Fed's backing off sometime next year, we're going to see dramatic declines in yields and big appreciation in treasury bonds.
Okay. Peter, where are your best plays internationally?
Well, I agree that we could be headed for a global recession, but the worst place to hide out will be U.S. long-term treasuries. I think interest rates in the United States are going to move dramatically higher, and not only will the value of treasuries drop, but the value of dollars in which they're denominated will fall. I continue to favor, as I've been for the last 5 or 6 years, conservative non-U.S. dollar dividend-paying stocks. The precious metals, gold has been moving up, almost daily. I still like commodities and raw materials, and I like to invest in countries that export commodities and raw materials. I still think the growth that's going to come in Asia is really going to be liberated once they get this giant 800-pound gorilla, the American consumers, off their backs.
But you see U.S. Treasuries yields rising in the midst of a global recession?
Yes.
Wow.
Yes,
Boy,
because of a flight from the dollar. It's going to happen. It's going to be because of inflation and a flight from the dollar.
Peter, let me just get one question, then we unfortunately have to go, but trust me, we'll have you back. In Asia, where in Asia specifically? Because Japan's had a huge run-up. And would it be China? Would it be India? Would it be Asia?
I still like China. I like to play it through Hong Kong. I like to play it through Singapore. I've liked those markets. There's good valuations. There's good dividend yields there. That's how we've been playing.
Okay. Gentlemen, Happy New Year.
Same to you, Sue.
Same to you.
Nothing better than a lively debate. Our thanks to Gary Shilling, president of A. Gary Shilling and Company, and Peter Schiff, president of Euro Pacific Capital.